it's a passive income book. The premise of the book was no matter how much you get paid per hour or per service, you can be the highest paid person in the world at that service. But if you get sick or you get hit by a bus, the music stops. And so, true wealth is having control of your time. And to have control of that time, you need something that's feeding you that doesn't require your efforts. And so.
Welcome everyone to the podcast. Today I'm thrilled to have Dr. Tom Burns as our guest. Tom is an entrepreneur, retired orthopedic surgeon, and physician for the United States ski team. With over 25 years of real estate experience, he has acquired or developed over $700 million of real estate locally and internationally. He remains active in the real estate and private equity markets today. Dr. Burns is also the author of Why Doctors Don't Get Rich, a best-selling personal finance book for those who want to live life to its fullest. He's a sought-after speaker and founder of the Rich Life Mastermind, designed to help people create their own financial independence. Welcome, Tom.
Hey, good to be here, Ravi.
Yeah, it's good to see you again. We were just discussing before the podcast that we last spoke at an immersion event Viking Capital had, and you gave a keynote speech, which was phenomenal. So I'm really excited to have you on, and you could share some of those insights with us today.
Hey, I appreciate it. You stayed for the whole thing. I probably would have walked out.
I was there. I was the one guy in front listening. Awesome. All right, so let's go get started with a pretty simple, straightforward question. What motivated you to start investing in multifamily real estate, and how'd you get started? And maybe you could talk about a little bit about your background story as well.
Yeah, I'd probably just give the story because that kind of gives the motivation answer.
Yeah.
I tell everybody I started just fooling around playing sports and doing that when I was younger, and had no great desires to do anything else other than play sports. And then it became pretty evident that nobody was ever going to pay me for that. So I decided, hey, I'm gonna be an orthopedic surgeon, sports guy. That way I could hang around with athletes. That's who I was used to hanging around with. So that was the plan. I went to med school, did residency, did a fellowship in Vail, Colorado, and then, moved on and did my private practice in Austin, Texas. So, I was following the path that most of us follow, whatever it is. You get out of college, make whatever mistakes you do in college. I did get in a little trouble in college. And then med school. And then, you try to match it the residency you want. So I got in my residency. I was in Cincinnati, Ohio, 5-year orthopedic residency. Just doing my thing. And as you know, we're all trained under an apprenticeship model. We're trained by folks that are 5, 10, 20, 40 years ahead of us, right? Those are the people that we are supposed to be in one fashion or another in the future. That's our future life. So I watched these guys and gals, and I just saw little things. I saw them late in the hospital at night. There were residents and fellows and people to do so, but these folks were, they were 10, 11, 12 o'clock at night. They were in the hospital. As I got to know some of these docs, I started to notice that they were maybe on their second or third marriage. And as you sit in the lounge with them, they're talking about being trapped and not being able to handle the insurance companies, just whatever. So, things that we all hear now once in a while. And so, having I hadn't been exposed to the medical world except for med school and this residency. So, in my mind, I saw it enough times. I figure it was either blind luck or touched by an angel. I finally looked at the lifestyles they were living and decided I didn't necessarily want their money if I had to have their life. I didn't like the situation they were in. So I decided I needed something else. I wanted something that wasn't correlated with medicine. I looked at a lot of stuff. I ended up on real estate because it just fits our schedule. It fits the life of a busy surgeon or busy doctor. So that's when I started, I started kind of looking at things, understanding the financial markets, understanding real estate. I had no training for it, 0 business classes. I knew nothing to start with. And just pretty much kind of started studying, talking to anybody that knew anything, and finished out my residency, finished out fellowship, came and started practice in Austin, Texas, paid a few bills when I got back. And as soon as I had things down to where I wanted them. I figured the next best way to learn was to jump in. So I started buying stuff, and that's the whole story. I started buying small, simple, little things, and the education grew, the projects grew, the zeros added to the projects. I found partners, and kind of ended up where I am today. So it was just kind of a natural progression. So that was my motivation. I didn't want to live the life I saw these folks living. And
Right.
quite honestly, it sounds like a lot of hubris, but I didn't want anybody telling me what to do. I wanted to go through life and have fun. And they didn't look like they were having as much fun as I wanted to. So that was the whole motivation for moving into something extra. Today we'd call it a side hustle, but that was just my extra job back then.
Right. So so it sounds like in residency, you really discovered that you came to this conclusion, and had this aha moment in residency. Is that right?
Yeah, that's when the light bulb went on.
Okay.
The only action I was able to take, we didn't have online stuff and everything on dating myself, but I had to read books, talk to people, and things like that. But that's where I was starting to get my education back then.
And how long did it take you from that point, working full time as an orthopedic surgeon, to get to the point where you said, "Hey, I have enough passive income where I can pull back a little bit on my surgery"? So I imagine you continue to practice for some time
I did.
afterwards.
Yeah, so it was a graduated thing. So it was probably a few years, 2 or 3. This time frame, I don't know, but it was a few years that I finally I had some money coming in. It's not life-changing money usually. I'd buy something that'd make me $150 a month in passive income, so that's not going to change your life, but that grows over time. I got enough of those and finally got to a point where I thought, I got some of this money coming in. So I took off Friday afternoons. I was working typical, I split my world into half days because surgeon. So I kind of worked 10 half days, right? Plus whatever call there was. So I took Friday afternoons off. So all of a sudden I had a 2.5 day weekend. It was the biggest gift I'd ever been given. I felt like I was Bill Gates by then. I had 2.5 days off.
Yeah.
And then just gradually as things grew, I altered my practice. So that was me altering my practice to make life a little more fun. I took more and more afternoons off. Over time, as the income grew, I stopped taking call. I tell folks I stopped taking call in the last millennium, in the 1900s, because that was a big deal. I mean, I was not only on call, my name was taped up. My name and phone number was taped up in an outlying hospital here in Texas. I was on call 24/7 for
Oh, wow.
years and years. They called me every day, or they called me for everything. So it was real nice to get rid of that. So it was just a slow, gradual process, like a little titration of lifestyle, and got to where I wasn't taking call. I was working mostly mornings. And then the whole process itself probably took 10 years. All of a sudden, one day I realized, wow, I actually brought in more from not working than I did working as an orthopedist. And then I worked another 12.5 years after that.
Okay. Yes. Like most physicians, you don't want to give it up. I mean, it's part of your identity. It becomes your identity.
Sure.
And even though you were financially independent. So would you say that was around 40, 45, around that age?
It was probably, let me see, 15, 20 years, probably more like 45. Yeah.
Okay.
You know,
So at 45, you started realizing that you were getting more income from your passive investing
yep.
than you were from being a full-time physician. And how
Right.
many years did it take you to get to the point where you just started dabbling to the point where you were making enough income that supplemented or surpassed your physician income?
Ask that one again. Ask that again.
How many years from your first investment into multifamily or real
Yep.
estate rather to the
Yeah.
point where you gained financial independence? How many years did that take?
I think it was about 10 years.
10 years. Okay.
Yep. Just slow, steady, just a whole series of, hitting singles, so to speak. But they compounded over time. It doesn't change your life. Like I said, my first deal made me $100 to $150 a month. Not life changing, but it was fun. So I wanted to do more. I got kind of addicted to that passive income. So I bought more and more. I bought 12 of those particular properties, and then things just kind of percolate along. But over time, with compounding and inflation and et cetera, it just kind of moves along, gets larger, and then it just did a hockey stick near that 10-year period.
I see. And it sounds like you were not just a passive, but an active investor. You bought these and managed them on your own. Is that correct?
Yeah, because there wasn't much access to passive investments back then, and so it sounds like the dark ages. But there were, we just didn't have access to them. They were probably there, but all I knew was go buy something and rent it to somebody, for more than it cost to own it. That was real estate to me, just simple math. So everything was mine. And I got to a point where I had a reasonable little portfolio of stuff that I had bought, and big surprise, you kind of run out of money over time because the projects get bigger. So I started asking friends and family, hey, do you want to go in this deal with me? Started getting investors that way, and then I got partners who wanted to do things together, and those projects got bigger, and it just kind of grew like that.
So as you escalated, what was the largest deal that you did?
Oh gosh, so the first bunch were small stuff, little single unit deals. I actually started buying student condos. Not very exciting, and I'm not a big condo fan, but it's worked out. I bought them right. I still own them, by the way,
Oh, nice.
and I haven't seen any of them since the day I bought them, other than to drive by. So I did that, and then I reached a point where I felt like I was hitting somewhat of a ceiling. And I had a good friend who I vacationed with. It was a buddy of mine. He was in real estate development. I said, look, man, I like what you do. Will you teach me? And I always joke, especially on shows like this. He looked at me and laughed. And he goes, you're a rich doctor, man. You don't need to know this stuff. I said, teach me anyway. So I worked for him for 18 months. Didn't make any money. We were doing land deals and finding land for banks and stuff like that, and build-to-suits. And I was just kind of learning things. But from that came probably my first big project. And it started before the year 2000. We finished it in 2001, which was the first phase of a medical center. So, about 75,000 square feet. We've since added on in 2004. So we've got 155,000 square feet medical center, and just he and I own it. And so we still have that today. So that was certainly at that time, the biggest project. And really, probably as single projects, that may be one of the biggest single projects I've got, because that's closing in on $100 million worth of real estate there.
I see. So,
and then, go ahead.
Yeah. So with this lifestyle, I'm really focusing on that period of time. That maybe 10-year period where you were actively operating and you were a surgeon and doing this real estate investing. How did you balance and juggle these dual careers? And you sort of explained how you'd pull back a little bit once you gained enough income that you felt you could take less call. But so that, I'm sure, obviously helped. But how did you juggle that?
Yeah. So, early there was, it was still I was doing everything, right? I was a young surgeon. I was the new guy in town. So they sent me all the junk on Friday afternoons. I used to joke my block time was Friday afternoon at 5 p.m., so I was always in the emergency room or operating room on Fridays. I think you always, if there's something's important to you, you'll make time for it, right? We've all got the same 24 hours. It's important. So it was important to me. And so I did it when I wasn't being a doctor, 100% focus on being a surgeon. When I wasn't doing that, I would 100% focus on the real estate stuff. So, it might be phone calls at lunch if I had any time for lunch. Certainly it was mostly evenings and weekends. I knew from the start that I was never going to manage anything. I knew I'd be a crummy manager.
Right.
And so I worked, that was all part of the underwriting, was to have management. So they took care of all that.
Right.
There were times, like, when I was learning from my friend, we had to do stuff in the afternoon. So I would cancel office. I made the conscious decision to cancel revenue producing obligations to learn for the future. I figured there'd be more return on investment going forward. So, I did sort of pay for that. I would cancel offices. I certainly wouldn't cancel surgeries. And so you just do it when you have the time. As I started titrating back and having, less time in the office, I had that Friday afternoon to do work, and then I had Wednesday afternoon, whatever, I did that. But you find the time. I mean, even up until the time I retired, I was, I would see a patient, and sometimes I'd check my phone and answer an email or or talk to somebody, you know? So it just, you find the time.
Yeah, yeah, and what you're saying completely resonates with me in that, I followed a very similar path in that I was working full time and investing at the same time, and my wife and I were buying these small multifamily units, and we're living in them and renovating them, and also working full time. So it was a lot, and there were definitely days where I was just burnt out, but I knew there was a goal. There's a goal that I had, and I was shooting for it. I want to talk to you about key strategic decisions that you made that enabled you to scale, because you mentioned a few things that I think would be really important for listeners to understand. And the first thing you mentioned was that you partnered. The second
Yeah,
was that you knew you didn't want to manage. Like that was
right.
not your forte. Because when I speak with people that own multifamily, they're like, "Hey, I'll save some money and manage it on my own time." So if you could just speak to those things and other strategic decisions you made that helped you grow.
Yeah, sure. And probably most of it was luck, or laziness, so sometimes I say laziness leads to fortune. Yeah, I would submit. Well, I'll just say I was, so what was I? I was a, kind of okay athlete, and then I'm a doctor. That is not a good resume for a property manager. And so I would, I would those that say, I can manage it, you manage it myself and save money. I guess you might early on in the balance sheet, but I think you actually potentially could lose money that way because a professional management company is going to pick the right tenants for you. They're going to have them pay for the application fees. They're going to do background checks. They're going to get you good tenants. And anybody such as yourself that's owned any kind of residential real estate, you know that a good tenant's worth their weight in gold, and a bad tenant is just it's horrible. And so turnover costs money, damages cost money. So that is why I've always had everything managed. I took one property once after I must have had half a dozen properties, and I took one that I managed myself just for about 6 months, just so I'd know, so I'd feel the pain. And,
Yeah,
I did it just to try to enlighten myself, just, make me a better manager of my managers. I'm not sure if it helped or not, but, when I was out there soldering, putting a, PVC pipe together with that purple stuff that you got to slosh around it, I realized I shouldn't be managing. But I'd already made the decision before. So management it'll make you money. It just will. It'll lower your turnover. It'll lower your maintenance costs. It'll get you good tenants, worth its
yeah,
weight in gold. Just put it in the pro forma, consider it a necessary expense like electricity and your debt service. Um, the other part was partners. I didn't, I had no grand plan. All I wanted was stuff that would make me money while I was working, sleeping, playing with my kids, or on vacation. So I didn't always buy real estate. I bought cell towers and notes and stuff. I bought anything if it brought me money. Uh, but over to what happens is when you're in the market, I bought a covered and the price went up. And, by that time, people realize this guy will close. We're going to bring him good deals. And then other people hear about it and they come want to partner with you. Hey, can we do, I've got this 40 unit deal, student property. Will you partner with me? Oh, sure. So, uh, partners come when they know that you can perform. Uh, the other partner again came, the medical center partner came because I was looking for some kind of mentorship. I was stuck. I wanted somebody that was where I wanted to be, to kind of teach me a little bit. And he was kind enough to do that. And we ended up doing that project together. So partners are great leverage. And a good partnership is worth its weight in gold. Again, just like tenants, a bad partner is painful, and it usually costs you money and all sort of things. But it's great leverage. Yeah, you leverage different skill sets, different time commitment abilities, and that is a great way for a working doctor to do things. If they find the right partner, it can be a nice marriage.
yeah, yeah. I 100% agree. When I first started, I was doing my own deals and
Mm.
just managing them myself. And then I soon realized the power of a property manager because that just saved so much time and brain damage. I mean, it was painful dealing with tenants at any given hour. And I think back to those times and I cringe. But that was one of the best things I did. And the other was to get a partner. Vikram, as you know, Vikram Raya, my business partner, we're like yin and yang. We're very similar in a lot of ways, but very different in a lot of ways. And things that he does, I couldn't do, and things that I do, he can't do. So like we complement each other very well. And that's the important thing. You got to find a partner that complements you, and you can grow together, because it's not when you have somebody else. And what I've seen in so many different ways and examples is it's not a linear growth. It's an exponential growth when you have the right person.
Right.
And it sounds like that's what you experienced. That's what I experienced as well.
Yeah. And, and then, it helps you with scale, and then you start replacing the 80% of your duties that don't really have that much bang for their buck, and you start replacing that with people that you hire, and you start focusing on your core 20% that really brings in the rain. Right. So, that's just a way to scale up. You hire out the stuff that you're not necessary for, and just keep honing in on what you're best at.
Absolutely. Okay. So you also wrote a book titled Why Doctors Don't Get Rich.
Yeah.
Great title.
Thank you.
What are some of the biggest financial pitfalls doctors face, and how can they be avoided?
And it's not just doctors, but I always tell people I've been working for 30 years to beat the doctor out of me, and I don't mean that in a bad way, because I am you. We are all this. We're scientists. We love proof. We love peer review. We want everything to be just right. In my world, you can't. You don't want to cut on a guess, because you can't uncut. An incision. So. There's sometimes a bit of analysis paralysis. Nice to kind of get over that. The main thing, and if you look at Robert Kiyosaki's got a thing called the cash flow quadrant. Most people have seen that. Bottom left is the self-employed person, which is most doctors now are on that left side. They're either self-employed or they're in the employed quadrant, and there's just no scale there. And so I was told 30 years ago, hey, why do I want to invest and wait a year to start getting my money? I can just go take call today and make it, but you have to perform that action every time. So, so that's one thing, the trading the time for money. Most people listening to your podcast have pretty much gotten over that, and know that, there's other ways to make money. I won't call them better, just other ways to make money. And so the premise of the book was, it's a passive income book. The premise of the book was, no matter how much you get paid per hour or per service, you can be the highest paid person in the world at that service. But if you get sick or you get hit by a bus, the music stops. And so, true wealth is having control of your time. And to have control of that time, you need something that's feeding you, that doesn't require your efforts. And so that's the whole effort, the whole premise of the book. So, no, I think we're all, I think doctors make great investors. They're great at analytics. They're great at facts, and real estate is numbers. And so, if the numbers work, numbers will tell you what to do. And so
Right.
if you do good numbers, then and relatively analytical, and then you get good partners, you're in a good position.
Yes, absolutely. With that financial freedom, becomes time freedom, comes geographic freedom. And that is so important. And then also, as part of that, you also have, with the time freedom, you have the freedom to pursue activities that you're passionate about, activities that improve your health, different charitable type, things that
Right.
you desire to do. I mean, there's so much that comes with that. So it's all about focusing on the right investment, the right opportunity, building that financial independence so you can do all the things in life that you're passionate about, and will bring you joy.
Yeah, and people kind of scoff at that financial independence, phrase sometimes, but man, that's what everybody wants. We're all looking to quote retirement, right? That's when we can take it easy. Well, let's take it easy when we're 35 instead of when we're 65, 70, 75. It's just a numbers game is all it is. And so much good can be done with smart, motivated people that don't have to worry about trading their time to feed their kids. And so I just think, I think it's almost incumbent on us that have the motivation, the smarts, and the desire to create that sort of situation for us. It's incumbent on us to do that so we can go out and impact others. As doctors, we impact people one at a time, right? And that's
Right.
great. And I loved my job. That's why I kept doing it for so long. But you can impact a lot more people at a time if you've got time freedom and can really devote your talents to something that can really kind of help the world or your local community.
Yes, yes, absolutely. Absolutely agree with that. Um, Now, let me ask you this. What advice would you give to high-income professionals, doctors, whoever they are, who want to start investing now, given what you know, what you've experienced, times have changed. What advice would you give them right now?
But find, number one, figure out why you want to do this. I know it's everything starts with why, but that's why Simon Sinek wrote that book. You got to kind of know why you're doing this. And once you do that, that's something that'll pull you through during the tough times, because it's not all good times. You see, as I mentioned, even at that conference, you see people on stage like, oh man, everything went great for them. Well, usually the people are on stage because they made more mistakes than everybody else in the audience and just learn from them. So, figure out why, find out what you like that you're excited about to get involved in. And then, and put your focus and time to it. Try to understand it like you do your profession or your medical specialty. And then, try to exercise, the best investment real estate hack in the world is persistence and compounding. This thing is not necessarily a sprint. It's certainly a marathon. So be comfortable in the fact that it's a persistence thing. Some of the things that I've done, I got to where I got by hitting a lot of singles, looking for small deals or safe-ish deals that over time compounded. Most of the time when I swung for the fences, I usually struck out. So, just keep trying to do good deals, understand what you're investing in, stay the course. It won't change your life in week one. It may not change it in year one, but it can move pretty fast. And I think people can move a heck of a lot faster than I did. I just was kind of plodding along, and it worked well for me, who didn't know what he was doing. So, yeah. And then, keep learning something every day. You'll get really good. You'll be thought of as an expert in your field, like you and Vikram are. And that helps leverage for you. And just kind of be persistent, and you'll be surprised what happens. Magic of compounding is really real.
Yeah, yeah, consistency. It's all about consistency and not being scared. Regardless of the economic cycle, you maintain what you've learned. Maintain the same underwriting that you do in good times. You maintain in bad times, and you just
Right.
change the numbers around. And if the deal makes sense, you go for it. That being said, and just talking about market cycles, in your whole experience as a real estate investor, I'm sure you've gone through many market cycles. Where do you see the market headed now? What do you see as opportunities? Maybe potentially red flags?
Yeah, but I always disclaim with the fact that my crystal ball is always fuzzy.
Right.
But real estate, it's life is waves. Real estate is waves. There's all cycles, and cycles have differing lengths. Sometimes it's a high frequency and things move like that, and sometimes they're slow. So, I'll go back to when I was in residency. I bought my first house with a 10% interest rate. It worked. It made sense. So, the market will equalize the gap between cap rates and debt right now is really thin. So and sometimes reversed. So a lot of deals don't make sense, but they will in time. So I think things are gonna smooth out. I don't know in which way. I can tell you, we've done one deal this year. Well, one and a half, I guess I should say. One of them straddled the end of the year. So, and we're looking a lot. People that I know that do several deals a year. Have done none yet because they're just not there. But deals are out there. People are doing deals. I know you guys are finding deals. Just use as you said, you just use the same underwriting program, and eventually, sellers, buyers, and interest rates will all come together. If you look at number, you and I are somewhat homers. We like multifamily, so does the rest of the planet, it seems like. But if you look at the numbers, between now and 2035, we still need 4 point something million units. Austin itself needs, I think I just saw the number, like 600,000 or 700,000 units in Austin, Texas, for the next 12 years. That's nuts. So we know we're underbuilt. I think people that are developing right now, I think they're going to be sitting in pretty good position in a couple of years. Because I think there's going to be a decrease in deliveries. I will tell you that I'm kind of going off on a tangent, but I'll bring it back home. I will tell you that the projects that we started before and during COVID have really taken some effort to keep them going. Time overruns, cost overruns, things like that. But eventually they'll be fine. So I think multifamily is still going to be good. Most of the world's still going to want to be in that asset class, but that doesn't mean you can't find a deal. The rest, if you have the knowledge base, still storage is still working for certain people. That's still in consolidation mode. Industrial, some people, on one hand, some people say it's, last mile industrial still in good shape. I was with Sam Zell a year ago before he passed away, and he said he thinks industrial's overbuilt. Again, I would say everything's local and regional, right? So you can't look at national statistics. I own office. I own medical office for a reason, and I own student property for a reason. Very recession-resistant properties. So, I personally probably wouldn't buy much office right now, but with the right business plan, I have friends that made fortunes when they were buying 50% occupied office buildings, a couple of decades ago, 2-3 decades ago. So you got deep pockets and a good business plan. One day those are going to come back. There's going to be profit to be made. So I could kind of go down all the asset classes. So I think really the profits to be made, and focus on what you're good at, or what your team's good at, or what you understand, and keep looking. And if you can't find it locally, look regionally. If you can't find it regionally, look in other states. There's always people on the ground that'll find things for you, or partner with somebody that's in an area you want to invest with. So there are always opportunities. There was an old real estate guy named Dolph DeRoos millions of years ago. One of his favorite quotes was, "There's always a real estate deal of the century right around the corner, no matter what the economic situation." And I believe that's true.
Yeah. That makes a lot of sense. And I agree with what you're saying completely. I think it's just all about being very knowledgeable and focused in your lane, and making sure that you're sticking to it, you're consistent with it, and you're making the best decisions you got to make, and leveraging people that like, and trust. And that's why we're doing this podcast, to really impart on our investors and our listeners knowledge that we wish we had when we started, so that they can make educated decisions.
Right.
So let me ask you another question. You mentioned, to start slow, start with smaller deals. Do you still advise people to start buying their own real estate to start, or would you advise people to start as a limited partner in a syndication?
I think be honest with you, I'll talk out of both sides of my mouth. I think you can pick your poison, because people are made up different. Some people really like that active portion of real estate. It's all I knew back then. And so, you can still start pretty small, buying something small, and you learn a lot because it's all on you and you're doing everything. So a lot of education there. That first property I bought, I knew zero. And literally the guy said, "Okay, we got the property." I said, "Awesome. What do we do next?" He said, "Well, you got to get an inspection. You got to go get a loan." I said, "Great. How do I do that?" So it was, you learn when you're doing this stuff, and you get really good at it really fast. So that's one way to go. And always the reason I say start small is because, there's going to be mistakes made. Yeah, I can promise you that. If my history is any example, there's, mistakes that continue to be made, right? So you'd rather, no matter what mistake you make, the lesson's going to remain the same size. So why not get the same size lesson for a smaller investment and a smaller loss? So, never pass up the chance to make a good mistake. And on the flip side, there is so much availability now of syndicated deals. That's a good thing and a bad thing. As I tell people, the people that are raising money, there are good deals out there and there are bad deals out there, and both of them will find you. So I suggest to them, prior to investing in things like that, to, try to get in some sort of affinity group, listen to your podcast, get with people that are investing already. And there will be people that have experience with certain types of sponsors and certain people. And that'll give you an idea of who to go with. And then maybe you start small with them. Even in my firm, we tell people, hey, just put in a small, below the minimum, put in a small amount if you just want to put your toe in the water and see how things go. So with syndications, you'll learn. You'll see how the reports come in. You'll look at rent rolls. You'll see how the sponsor evaluates things and how they communicate with people. That'll give you an idea of what kind of sponsors you want to deal with. So it's all experience, and you don't have to start big. And I know, I'm telling you, if I was in medicine right now, just starting out, I might want out tomorrow as well. I know there are people I've talked to, they said, I want out yesterday.
Yeah.
And I wish there was a magic wand, but this investment game is not, it's not a one-time thing. And that's where I've been, I've been burned a few times trying to take those big swings. So the hardest part is having patience, understanding that the deferred gratification is going to be important, and you're going to get there. And you may get there in 3 years, you may get there in 10 years like I did. Hopefully you're not a remedial learner like I was, and you get there faster than I did.
So, we tell folks when they ask us that, because a lot of people approach us and ask us about various deals in different markets, and we're happy to answer those questions. So, if you listeners out there have a deal you're looking at, and you want us to take a look at it, our investor relations team does this all the time. And we look at other operators and we'll tell you, hey, this is how we see it. This is good. This is not good. This makes sense. This doesn't. But that's a way to, leverage people that to help you make decisions, especially if you're getting started. So talk to the IR team of that particular sponsor, and then talk to us and get our take on it. And we'll try to give you, obviously, the best objective advice we can give you, and then compare that to something else, and then make a decision there. But those are just simple tricks that you can use to leverage some of the resources out there that are free and available to anyone.
Got it.
All right, last question. I think this is a great way to end. What would you say the best financial advice you've ever received was?
I'm thinking of Warren Buffett saying, "Don't lose money," but I already blew that rule. So lessons learned, right? So I got a good lesson on those deals. I go back to Darren Hardy's book, The Compound Effect, and back to what I said, that I'm sitting where I am now, wherever that is, because I just hit a whole bunch of singles and just kept coming to bat. So I just got anything that would make money and produce cash flow. And Robert would always say, if it doesn't make you money on the tee box, then it's not a good deal. And so always made sure there was cash flow with those deals. I broke those rules a number of times, won a few times, lost more than I won. So, have it bring in, particularly if you haven't covered your expenses, have something that brings in cash flow for you. And if you figure out how to do that, just lather, rinse, and repeat. Get good at something and stay in your lane. Again, personal experience, I can tell you, when I've gotten out of my lane, I've gotten into trouble. So I pretty much have decided I'm going to stay in my lane until I'm pushing up daisies.
Yeah. Excellent. Well, Tom, thank you so much for this. This was wonderful. If people want to learn more about you, what you do, I know you have a mastermind. They want to learn more about that. How can they do that? Yeah, the website is richdoctor.com. And you can email me at hello@richdoctor.com. I always answer them. Wonderful. Well, thank you so much. All right. Thanks, Rob.